Hello everyone. Hi guys.
Hello, sir.
Good morning, sir.
Good morning. How are you guys? Everyone
Good
okay?
morning.
Yeah, good morning everyone.
Good morning, sir.
Good morning, sir.
Good morning, good morning.
Good morning, sir.
Good morning. Anything new? Anything new? Any update? Let us wait for a couple of more minutes because I can see only people online as of now. So Sumit is there now. Sumit is there, Vibhav is there, Sudiksha, Jishika, Bhavya, Kapoor, Abhinav. Okay. Let me just quickly take your attendance also. Give me a second. Okay, Abhinav was there right yesterday, and he's today also.
Yes, sir.
Okay, Altamash was there yesterday. He's not joined as of now. Okay, Anurag was there yesterday. Apur was there. Bhavya was there. Okay, Harshit was also there. Shika was there, and Mayank was also there. Prakhar was not there yesterday. Siddharth was there. Sudiksha. Sudiksha was there, right? Sudiksha.
Yes, sir.
Okay. So was there. Suraj was not there. Weber was there. Vishal was not there yesterday, right?
No, sir, Vishal wasn't there.
Okay. Okay. So today Altamash is not there. Anurag is also not there. And Apurv is there. Bhavya is there. Harshit is there now. Shikha is there. And Mayank is there? No, Mayank hasn't joined. Prakhar hasn't joined. Siddharth is there? Siddharth hasn't joined. And
Hello. Sir,
Siddharth has
I'm
joined,
here.
right? Okay, Siddharth has joined. Okay, fine. Sudiksha is there.
Hi, sir.
Sumit
Good
is
morning.
there. Yeah, hi, good morning. Okay, so Suraj is not there. Hmm. Vibhav is there. Vishal is not there as of now. Okay,
Sir,
fine.
attendance of 22nd
Sir,
November, last
22nd.
Sunday. Uh, mo-
Oh, yeah, mock. Yeah, right, right, right. So give me a second. Let me also take.
yes, sir, call me. Good.
1 second. 22nd November, right? So on 22nd we have Avina was not there. Altamash was not there. Anurag was not there. Apur was also not there. Bhavya was there. Then Harshit was there. Ishika wasn't there. Mayank was not there. Prakhar was also not there. Siddharth was there. And then Sudiksha was there. Sumit was there. Suraj wasn't there. Vibhav was there. Vishal was there. Okay, so that is it.
Sir,
Okay.
hello. Prakhar
Yeah.
here, sir.
Prakhar
Kindly take
joined.
my attendance. Yes, sir, I joined.
Okay, Prakhar. Okay, okay. Prakhar, okay, fine. Prakhar, you were not there yesterday, right?
No, no, sir. Yesterday I have an exam for SBI. That's why I am not able to.
Okay, okay. Okay. So, okay, Prakhar is there now. Anyone else whose attendance I have not taken so far? And there the person has joined? No, right? So Altmash is not there, and Rag is not there, and then Mayank is not there, right? Suraj is also not there. Vishal hasn't joined. Okay, fine. So let us now start.
Vishal might be
So
coming, sir, within 5 to 10 minutes.
okay, okay, fine. That's fine. So we did uh, forwards and futures yesterday, right? Today we would be covering the option, and yesterday there was one exercise at the end of presentation. I assume everyone has done that exercise, and if there is any confusion, something not clear with that exercise, you want to know more about how mark to market and profit and loss is calculated, do let me know. And there were also an exercise earlier wherein there were three questions about hedging, and those all there were three questions in between while we were just going through the presentation. So I expect like whenever you have such exercise, do those exercise and come up with your thoughts so that we can discuss them. Right? Anything not clear, do raise so that we can cover them again.
Sir,
Okay,
I
so
just had one
let us.
question.
Yeah, we would go ahead.
Sir, actually, somewhere I read that once options bought can also be converted into
Hmm.
shares in some time in future.
Okay, so that is okay. So those are called warrant, right? So warrant is also it is a kind of an option only. Warrant is a kind of an option. It's an OTC product, more of an OTC product, not an exchange. So wherein this gives an uh, opportunity to the investor that they can buy a warrant, right? So this again has an option of call and put both. So an individual can buy the shares of a particular company after exercising that warrant, right? So that way it acts like a option. So the warrant is one of the financial product which is available in the financial market wherein you can avail the opportunity to buy the share of a company after a certain period. So there are different kind of option warrants available. It is just one of the warrants which I told you right now, which is the option only. It acts like an option. So you have an opportunity wherein you can exercise your or warrant and avail the number of shares which are attached with the warrant, similar to the option also. Like when you exercise a put option, you can actually buy the number of shares of that particular company, right? So from the seller point of view, or from the caller point of view, also from the call option also, you can buy, you can take a physical delivery, right? You can cash settle, you can also do a physical delivery. So physical delivery means you can actually hold those shares which you tend to buy by buying agreement or buying purchasing that derivative agreement. So that is the idea of going into option or buying an option contract, right? Similarly, the warrant also gives this opportunity wherein you can buy the shares, right? So it is true. The normal option also have the this is there wherein you can buy the shares. It is not with a normal option you can't buy, but there is another financial instrument available in the financial market, the warrant that we call, and the different kind of warrants available. It is the one of the option which I one of the warrants which I told you, wherein you can exercise the warrant and avail the shares. And the good thing about warrant is, like in option, the option have got a maturity of a 1 month, 2 month, and three months. In case of warrant, the expiry could be delayed, and it could be of a it can be of a higher time duration. Can be for years also. That's a good thing about warrant. And there are embedded warrants which come along with bonds, as we probably I discussed this thing earlier also, wherein you avail some bond, and then that warrant is there. So at a later stage, during during the life cycle of that particular bond, you can exercise warrant and can avail additional shares of the company. The bond will continue. The bond which you are having will continue, and you will avail the interest and everything on the bond. But at later stage, you can also exercise a warrant which comes with the bond only. So that is the reason it is called embedded warrant. So it is coming as an embedded feature with the bond, and you can avail exercise a warrant to have those additional shares of that particular company. So that is also there. And if you when you look at buying a number of shares, so that you can also this option also. The normal option also allow you this feature wherein you can actually buy those shares. So just to today we're going to do the option more. So we would be talking all this stuff more today, so that you have a fair idea about all these things that we actually should understand. So when you go for a call option for that matter, as let me just start with the call option, and let me also open the Excel file. Give me a second. One second, just let me open the PPT and then the Excel file so that we can start. Okay. Okay. So like we were yesterday discussing about TCS as a share. So if an individual, this was the future, but we can make a similar thing for the options also. So assuming there is a you are taking a call option for TCS price, and one lot, I'm assuming one lot equivalent to 300 shares. So one lot of TCS has got 300 shares, and you're taking a strike of 2100. The same example I'm talking here. So what the call option says, call gives a right to the investor to buy a security at a predetermined price at a specified time. This is what the call option talks about. As a definition, the technical definition, when you look at the call option says, you can buy a derivative, you can buy the underlying asset at a predetermined price at a specified time. So this is the call option has got for an investor. So when I agree with this particular contract which we have, so I'm buying a lot, one call option for TCS, one lot. Strike which I am taking is 2100. So, and the spot price I assume is 2000. Correct?
Yes,
So
sir.
this is the condition which I made for this example. So when you look at this example here, we can very clearly see, as an investor who is buying a call option can only exercise this call option these when this security, rather the TCS share, moves beyond 2100. Then it is a profitable deal for this investor, right? So how the deal would be profitable, because I have bet, I have got a bet of 2100 rupees. So if it doesn't move above 2100 rupees, there is no point exercising it because I've already lost my premium. So there is a premium paid, we know. So premium, probably, let me just make it 1500 or whatever. Premium wouldn't be 1500 for sure because it would be higher, but I'm just taking as an example here 1500. But usually if you go for a difference of 100, this and TCS is a bigger share. It's not a, because if you look at the price value, it's a 22,000 is a good value, and a share which have a price value of 2000, so 100 rupees movement is not a big deal. These shares can usually make a 100 rupees movement in a day. So 1500 as a premium is not very attractive to the seller. So guys, before we probably touch upon this concept, we need to, I'll be talking it again, but for the sake of this question, I'm telling this. So I have taken I have a strike of 2100. So at 2100 I can exercise and can get those shares. That means 300 shares I can get at 2100 rupees, right? So this is the idea of call option. This is the idea of call option. So either I can take a physical delivery of these shares at 2100, or I can exercise, I can have this cash settled also. So I can secure off my position at the end of the expiry and get the profit out of it, or maybe in between also. It is not necessary you need to hold it off until the expiry. You can also secure off your position in between the expiry period. So if it is a 1 month expiry that you have taken for an option and you see a profit being made before the actual expiry date, so you can also exercise before that, right? So this is how the options are there. So any question as of now before we actually deep dive and do more of the option now?
I have a doubt. Like in an option contract, one has to opt for call, the other has to opt for put, right?
No. So okay, good one. So like I am a buyer of a call option, right? So in this particular example that we're talking, there is a buyer of a call option, right? So there has to be a seller of a call option. So that how this would be completed. Okay. So there is a buyer. So when I say buyer of call option, right? A seller of a call option also.
Okay, sir.
Similarly, if I am a buyer of a put option, buyer of put option, okay.
Yes,
So there has to be a seller
of a put
of
option.
option. So that is how you are completing your legs. So call and put are uh, two different options, right?
Okay.
In the option category, so two options you have. One is your call option, another is the put option. So call gives a right to buy a share or buy the underlying, not share I would say, because it can have anything, right? So call gives the right to buy the underlying at a predetermined price at a specified time interval, right? So this is the definition of call, right? So this is an option. It's an option. So either you can buy or you can back out from the trade. On the other hand, when a seller is giving the right to a buyer, seller has to obligate that uh, that obligation. Seller cannot back out from that obligation at the end at the end of the maturity or at the end of the expiry. So seller is bound to fulfill the obligation. However, at the other hand, buyer has this option either to get it exercised or not get it exercised, and for this option, he is making this premium payment to the seller. So the premium is the profit for the seller. Seller nothing more, nothing less. Seller only has got this premium which is with him for this deal. If this call option, the example that we're talking right now, if it doesn't move beyond 2100, if it remains only below 2100, so that says seller has got 1500 rupees, and seller is not going to lose anything here, right? So this is how the options are. Any more question, guys? Okay, so let's come with slides and presentations, and then we would be talking more of the same. The option is a financial contract that gives an investor the right but not obligation to either buy or sell an asset at a determined price by a specified date, right? So that's the same definition that we talked about. So there are two different kinds of option that we have. One is a put and one is a call and another is put. So that's the reason either buy or sell is written there. So either buy for call, sell for put.
Uh,
Yeah.
So like in the last class, we learned that the call option gives the buyer the right to buy at a predetermined price. So the seller of the call option, does he has any right to like size or
No. No. So seller doesn't decide in either of the cases, either in call nor in a put. So if you are a seller, I am a buyer. So you don't have a right. I have a right to exercise it or don't exercise it. So I would exercise when I feel it favorable to me, when it is profitable to me. I would like to exercise the option. You as a seller don't have any right. You need to you are bound with the obligation of exercising it when I want to exercise it. So you can't have choice. You need to you this obligation is binding on you. You need to fulfill that obligation which is there in the agreement. But as a seller, as a buyer, I can think whether it is a good deal for me or it's not a good deal. Accordingly, I can get it exercise or want exercise, looking at the situation if it is favorable one or not favorable one, right?
yes, sir.
Okay, so let's move on now. So option is a contract right to buy or sell an asset, predetermined price, quantity, sells right. Seller of the option is selling right, basically you can say. So option buyer is having that right. Buyer has a right to choose, seller has to follow the contractual agreement, pay premium amount. And the what to buy this right, a buyer has to pay a premium. And just to give you a brief about option, in the option world, it would seem, if you go by the definition, when we talk, there is an option available to buyer, it looks, it is such a good contract for buyer, right? On the face of it, it looks really a very good instrument where a buyer has got a uh, very great deal of very great deal of advantage, right? This is what we can see by looking at the definition and when we actually go through the entire thing. But in the real world, the option sellers are mostly the one who make profit out of these deals. Option buyers are not so uh, hugely able to gain from the options in the real world. This is the story. I'll tell you how it works later on. But this is how the real world and the paper world wherein we are reading thing is different. The real world is pretty different than the than the information that we actually see in the option. Okay, so this thing is clear. Pay premium amount. So buyer is paying premium and the seller is receiving premium. So this is the good thing in option. Option refers to the right but not obligation a person enjoys. A person having a right may exercise the right received. Option which can be traded in the OTC and exchange market. So options, the vanilla options are mostly traded in the OTC market, and there are some exotic options which are part of your OTC market. So most of the options, as we look at the derivative market, we usually say futures and options are exchange traded product, but there are some exotic options which they are part of OTC market also. When the right is sold to a person, the seller retains the obligation and he has to oblige when the right holder exercise his right. The holder of right will exercise the right only if it is beneficial, right? As we discussed, when a right is exercised, it is beneficial to the holder, but not to the beneficial, but not beneficial to the seller, right? So this is, so what are pros and cons of option trading? So it gives you leverage, risk and reward ratio is there, unique strategies are there, low capital requirement is also diversification. So for an buyer point of view, these things are there. As if you want to take position in option, you do not need to actually put in the entire money, or you can just go with the with a very with that fee only. The premium is a fee for option, right? So that fee is what you are paying and taking position in option. So that is a the leverage which you have. Risk and reward is really high. So it goes and moves as per your expectation, then there is a great deal of reward. And the risk is also there. The risk is limited to your premium only. So from the buyer point of view, it is a premium which a buyer is losing. However, from the seller point of view, the risk is unlimited. Seller can have unlimited risk. From the buyer point of view, the risk is only the premium which the buyer is paying. In unique strategies, there are a lot of strategies. The lot of strategies which option has got. We would be doing some of the strategies. Not every strategy would not be possible. There are a couple of them that we would be talking about in this option chapter, and that is from the understanding point of view. Because if you actually go with the real life thing, the lot of things which actually come into. But from the understanding point of view, we would be covering those strategies, how those look like. And low capital requirement we already covered. It's a diversification. It's a kind of a diversification because you can take options for different things. Option is available for commodity, option is available for stock, option is available for Nifty. As we were talking yesterday, the Nifty options have expiry of weekly expiry also, and that's a good thing. There was a time in the Nifty bank Nifty options were available for monthly basis, but now it is even available for monthly basis. So that's a good thing. And the disadvantages: lower liquidity, higher spreads, and higher commission, complicated time decay, less information, options not available for all stocks. Okay, so these are the disadvantages. Options have got some disadvantages also. So if you look at the liquidity, it is not that every option has got a high liquidity. There are some options which there are some options which don't have high liquidity, because it is dependent on share only, right? So if the share is not good, the options would not be good also. So it has a direct relation with the share only. So if share is not good, probably the option liquidity wouldn't be good. Higher spread. So when I say higher spread, that means basically there is higher fee also, high commission which is charged by the broker also. For options, there are brokers who charge uh, some more fee, and there are discount broker who charge only 20 rupees per lot, and there are broker who charge 100 rupees per lot also. Right, so these complicated. Everyone doesn't understand option. They are complicated. Time decay is one factor that makes it unattractive, because with the time passes, the option reduces its value, and it becomes zero at the end of expiry, or the when the option is about to expire. So that day, it would be zero. It so less information in a sense. When you look at the share market, people talk more about share and the company, how the fundamentals of the company are, how the technically the company looks like, and all those stuff. But if you look at option, people don't talk option uh, that extensively like the shares. There are some information. I wouldn't say there is no information. There are information nowadays. Even there are shows which are conducted on options market also. If you look at some of the TV shows, there is a segment which is which is typically assigned for the options strategies and options and all that. So it is not that there is no information, but the information is not that hugely talked about like in case of share market and all. So that is bit a bit of a constraint when you look at the option, because there would be very few people who actually know about option and how to trade in option. The reason is because the information is limited, right? Options not available for all stock, we already discussed. So option is not, it is for every stock. So if I want to take an option for the IRCTC, probably this is not there, so I can't buy an option for IRCTC stock. So there are some stocks which have option, there are many stocks which don't have option, right? Any confusion, anything that you are not clear with this slide?
No, sir.
Okay, fair enough. So as we discussed, this is an option which gives the right to buy the underlying set at strike price. This is called call option. An option which gives right to sell the underlying asset at a strike price is called put option, right? So there are two options available. One is a call option, another is a put option. So these two options are there in the option segment, and one is giving a right to buy the underlying at a agreed strike price, and another is giving you right to sell the underlying at an agreed strike price. Okay, so long and seller and short. So this term short means someone who is selling something. That is called short position. Long position is called when someone is buying something, right? So these are techniques which you would see in the financial market or in the financial domain. So whenever people talk long and buy, people long and short. So when you are long, you are buying a trade, you are taking a buy position. When you are short, you are taking a short position. You are actually selling the trade. That is how it is talked. Okay, now moving to trading. Okay, so these are the two different kind of trades which are made under the option. So call option can have long call, can have short call, as we discuss here also, right? You said when there is a buyer of call, there has to be a seller of call. When there is a buyer of a put, there has to be a seller of the put. Same is what is written here. So there is a long call, that means buy a call. Short call means sell call. Similarly, when you're doing for the put call long put, so you're buying put, you are selling put, right? Okay, so now look at this call option. So what the buy option has, right to buy the underlying. What the sell option has got, it has got obligation to sell the underlying. That is short call. So it is just written in different statements so that you can relate it what we actually talking. It is just to put it the same thing in different words or different statement to have a better relation in mind. At times you're confused with the word. So we shouldn't be confused the word what the word is actually talking about. When you're saying short call, what it means, you are obligated to sell the underlying asset, right? Okay, one thing I want to check, because I just want to say and gauge like how we are actually able to relate it. So when you as a seller taking a short call, are you required to have those number of shares which you are selling? If you are taking a position on a stock, for that matter,
No,
you're
sir.
selling a share for a TCS example of the same company that we are doing since yesterday. So if you are selling a call option for a TCS company, do you require to have those number of shares with you? Because one lot has 300 shares. So do you require to hold those 300 shares? Only then you can do a short call, or you can do without even holding those number of shares with you.
So we just need to require the margin.
Okay.
We
Okay.
don't need the number of shares, because
Okay.
if we already are already having those number of shares and then we short them, that is actually not shorting shares. That is actually selling the present shares which you are having. So
Right.
that so in when you short, then you are actually not having those shares, but you are just having the margin.
Absolutely. Well said. Well said. So everyone is clear, right? Anyone not clear? Probably we can touch upon this piece again, but we need to be very clear why this is a leverage. When we talk about leverage, how this is actually a leverage.
Sir, can you please explain this short call again?
Yeah. So like we can see, you can see my screen, right? So here we have got two options. One is a long call. So this, when you are a buyer on a call option, so you have a right to buy the underlying asset which a call option has. And when you are a seller on the short, when you're short on the call option, so you are selling those underlying. So when I'm just asking, do I need to hold those underlying asset when I'm becoming a seller on a call option? Like, this is a question which I'm asking to you, so that I can make you relate. I can make you relate the whole situation. We need to have a proper relation in our mind also before we actually understand thoroughly, right? So if you don't have a relation, probably it would not be making more sense to you. So you need to have the relation. That's the reason I want to put it here in the Excel file also, the strike price, spot price, and all that thing. But you need to ask more question if you're not clear, so that I can relate it accordingly, put it into different words or different statements, so that you can probably have better clarity around it. Okay, so any other thought? When you're shorting, when you are actually selling a call option, do you require to hold those number of shares? Or are we not clear with what we're doing here? Maybe if we are not clear, then also you can tell me. I can rephrase it and probably make you understand in different point of view.
So I'm not getting this one particular, like the right to this long and short calls
Okay,
obligation.
no worries. No worries. So we can talk it again, right? So as we discussed, there are two kind of call option, two kind of options. So one is a call option, another is a put option that you can see on my screen right now. So every option has two legs. You can say every option has got two legs. So there are two legs. You can say there is a buy leg and there is a sell leg, right? Similarly, the put option has got two legs on two legs again. There is a buy leg and there is a sell leg. So when there is a person who is buying a call option, the person is assuming, why would I buy a call option? First of all, let's look at this thing. Why I would like to buy a call option? So I am buying, assuming I'm a speculator. I have nothing to do hedging and all that, right? I am a speculator. I am thinking the share price of this particular company would go beyond this price. Beyond this price means the strike price which I'm taking is the price which I think it would cross, and it would go beyond this strike price. So strike is what I am buying. When I am buying an option, what all things I buy? I buy a strike price, right? And I buy 1 month, 2 month, 3 month. What period I need? What expiry I need? If I need a 1 month expiry, I need a 2 month expiry, or I need a 3 month expiry. So these are the things which I am buying, and accordingly I would be charged a premium. So if I am buying an option for a uh, for the later expiry, for a 3 month expiry, the premium would be higher because it has got a time value. Time value is a factor which increases the premium of an option. If a option has got a higher time value, so that means the premium of that option would be higher compared to an option which has got a 1 month expiry. Understanding this point? So I am, as a buyer, paying a premium to the seller. Seller is getting that premium as a profit, nothing nothing less, as I said earlier also. And you have this option, and you might be assuming this price will cross will cross that you have bought in the deal. So this, if it crosses 2100 with this example, it is 1 second. This is the example, right? 2100 is the strike price that you've taken. The spot price is 2000 and premium you have already paid. So if it goes beyond 2100, that is when you would be making profit, right? So this is the reason why you are taking the option as a buyer. Why you are taking a position option? Because you think the share price of that particular company would be moving beyond 2100, and when it goes beyond 2100, so there would be profit to you, and that you would like to capture with this deal. So that is the idea behind doing the option buying, right? And what would be the idea behind option selling? So it has to be an idea. It has to be an opposite view. If I am as a buyer thinking the share price of a particular company would be moving ahead or moving beyond 2100, similarly, there has to be a seller who would be thinking the share price of that given company would not be going beyond 2100. It would be within that range. So that's the basic fundamental I'm telling you. So that is how these two legs are being made initially, right? Any doubt as of now? Similarly, when you look at put, right? When you're buying a put, why would you buy a put? Why would you buy a put option? What a put option has got in it?
Right to sell.
Right to
Uh,
sell, right? Yeah.
Yes.
yeah, when
Okay.
you expect stock prices going down and you should earn some profit from that thing, then you go for the put option, stock price down.
Yes. Yeah. So when you say it has got a right to sell, so right to sell means you would be able to sell the option at an agreed strike price. So in the same example, let's take an agreed strike price is again 2100 for for buy one lot of put option for TCS, right? So the strike is same which is uh 2100. Okay. So if it goes 2200, assume, right? What I am doing here, I'm buying a one lot of put option for TCS. Now the strike price is 2100, and the price of a stock has moved to 2200. What is happening here? Is it good for me?
So it's giving us loss of 100 points.
Okay, right. What about others? What about others? Everyone should be clear. Only you, when you actually understand it in this way, you would be more clear with your thoughts and idea that you are forming in your mind. When you have taken a strike, so strike is what strike means. Do you understand what when I'm saying strike, what strike means? So strike is same like you want to strike it when this is the price. You want to strike it, right? You want to exercise it when the price reaches this or beyond it. That is the strike. In call and put, it will slightly vary. The definition would remain same, but the directional view would be different. The directional view would be different. So that is what we both the options or not. So in the call option, we talked about the strike is this, and if it is the strike moves 2200, we are making profit, right? So in put option, you see the strike is you bought a strike of 2100, right? And I am saying the spot price of a share has moved to 2200. So what is happening here? Is it a profit situation? It is a loss situation. What situation is this for you, according to you?
Loss.
Okay. Siddharth, what do you think?
I think it's loss.
Okay. Harshit, what do you think?
I also think it's loss.
Okay. Bhavya, what do you think?
Sir, I also think it's loss.
Okay. What about others? Everyone thinks loss. Anyone thinks it's a profit situation? Anyone has a different view?
मेरी नहीं है, मेरी खाली अंदर पड़ी है सर, दिखा दूंगा आपको। है दिन की नहीं है, वैसी रखी हुई है, तो रात को बंद कर देते।
Everyone thinks same, right? Okay. Okay. So why do you think this way? Why it is a loss? It is a loss. Who would like to explain?
So should I?
No, no. Wait a minute. Let me first check with others. Who would like to explain? Who would like to explain it to me? Harshit, what do you have any thoughts? Well, like, why do you think it's a loss here? So, guys, we need to have these concepts very clear here only. Otherwise, these would be very difficult to understand later on. When you the strategies, right? It would not be easy to understand them unless we are clear with this concept here, because then we would be talking about a different, from different point of view. It would be difficult to understand those strategies for sure. I'm guaranteeing you. So we need to clear. Yeah, yeah. Go ahead. Go ahead. Who want to explain? Shika?
So can you please repeat the question? Actually, my internet is not that very.
Okay, no worries. So what I'm saying, there is a person, right, who has bought one lot of put option for TCS share, and the strike of that particular deal is 2100. The strike price which he has bought for the put option is 2100, right? Now the share price has moved to 2200, maybe the next day or maybe the few days later. So what is happening in this situation? Is the person making profit or loss? Profit or loss? If it is a profit or loss, why it is profit and loss?
In the buyer point of view, the buyer is making profit because the strike price, the price on which the buyer has booked is 2100, but
Mm-hmm.
it is loss for the seller. It actually not eventually the loss, but it's reduced the gain for the seller because he can also sell at the 2200 next day.
Okay.
So in
Okay. And
XCCAT, for the buyer's point of view, it's a loss. No, it's I
from
think it's a gain. It's a gain.
from the buyer point of view, it is a gain, right?
Yeah.
Okay. Okay. And Sudiksha, what do you think? What do you think? Is it a gain or it's a loss?
Sir, I think she just left a few minutes ago.
Okay, Sudiksha is not there. Okay, fine.
Yeah.
Okay, and then Apurv, yeah, Apurv, what do you think?
Sir, I'm not getting it properly, sir.
Okay, no worries. So let me put it in.
Sir, may I? Sir, may I?
Sumit. Okay.
Yes.
Yeah. So okay, hold on, Sumit. maybe a moment. So okay, okay. Maybe can you maybe just rephrase this question again, not the answer. Okay, Sumit, rephrase the question for everyone so that maybe they can understand from a different point of view,
Okay.
in a different way. Yeah, not the
Okay.
answer. You don't need not answer it. You need to rephrase
Okay.
the question which I'm trying to ask them so that probably others can have a different, maybe different way of looking at it.
Okay. Uh, the buyer of TCS is me. I bought one lot of TCS when the market price of the TCS is 2100, and I bought the TCS put option, one lot put option at the strike price of 2100 at rupees 100 premium. Now it is when I bought the uh, one lot of put option, market price was 2100, and I bought the strike
They're unable to hear.
Yeah, yeah. Voice is. I guess his connection is lost. Sumit, we can't hear you. Okay, no worries. So let me just rephrase it again. So there is a buyer for a put option, and the buyer is buying this option at a strike of 2100. So that's the agreed price which he has agreed with the seller. And next day, the share of that particular company has moved to 2200. Right. So the question is the buyer making any profit on that deal which he has done yesterday, or is the buyer losing? And if you say it is losing, probably give a very simple explanation so that everyone can understand why the buyer is losing on a deal. Yeah, Vivav, maybe Vivav, you can go and explain it to others.
Yes, sir.
Yeah.
Sir, actually buying a lot of put is just exactly opposite to buying a lot of call. So I'll start it from the lot of call, and eventually everyone can understand how the put option works. So
Okay.
as
Yeah.
explained by sir, if we buy a call option and we expect the market to go up, that is why we buy a call option. So over here, if we buy a put option, then we are assuming today or future at some day the market is going to go down, which is why we are buying option. So eventually what happens is the market goes down and the put option, the price of the put option, it goes up. So in this case the strike price is going to is 2100 and it went to 2200. So we expected the market to go down, but the market actually went up. So the premium of what I paid at the for the put option, it will go down in this case. So that is why this scenario is actually a loss to the person who bought the put option. That is what
Yeah.
in the easiest form I can explain.
Yeah. Yeah. Right. Right. That's pretty good. Pretty nice. So I want everyone to have a similar clarity because he has a clarity for sure, I know, and I want every one of you to build the same clarity. Maybe I'm not sure like how much you're getting it right now, but you need to have the same understanding. That is all, then only you would be actually understanding options better. So guys, so what we are trying to understand here is there are two options, one is call and one is put. So when you have these two options, there are two different views. When you're buying a call option, that means you see or you believe the share of that particular company would move beyond the strike price. It would move up and up and up, right? Similarly, when you're buying a put option, the fundamental view of the buyer is the market or the share of the particular company is supposed to move down, down, and down to the strike price which he has agreed on or he has bought, right? So that's the fundamental view which two players on different two options have got, right? So if I say the buyer of the put option has bought a strike of 2100, that means I would like the share price of this company to move below 2100 so that I can gain out of it, right? And what is my gain? My gain is a difference which is happening here, right? If I assume at the end of the maturity, what would be my gain? I'm holding this option until the maturity. So 2100 minus 2000, that means there's a difference of 100 rupees. So 100 rupees multiply by 300 shares. That's the gain I'm making on this contract, right? That's the gain I'm making on the contract. So
30,000.
30,000 rupees is the gain which an individual can make if there is a difference of 100 rupees from the strike to the price it is trading at. So at maturity, the individual can avail a gain of 30,000 by doing a cash settlement. Okay, clear? Maybe later on we'll discuss more on it. If not clear, you need to ask more questions so that you clear. Okay, so these are the two call and put explanation done. So as we already said, there is no need for number of shares. There is no need for a seller to hold those number of shares before a person take a short position in call option. Similarly, there is no need to have the shares when the person is taking a put option, short put option, or rather I would say buy option, because buy is giving a right to sell. So right to sell doesn't mean that you should be having those shares only then you can sell. No, it is not like that, right? So when you look at from the buyer point of view, what the buyer is doing, buyer is essentially selling those shares. But is the buyer really holding those shares when he is actually opting for the buy option? No, no, it's not necessary. Buyer is just paying the premium to the seller and is able to avail the right to sell those shares at a later date or the specified date in the agreement accordingly. Hope it is making sense. Okay, let's move on. So let's look at this slide here and try to understand what these two. So buyer expect the price to go up, seller expect the price to go down. So this is the view which two players in the option has got. One is a buyer and another is a seller. So buyer expects the price to go up. If the price goes up the strike price, then it is a gain for the buyer. If it goes below or it remains at the same level, probably it is not making any sense to the buyer. At the end of the maturity, if the price doesn't move up or beyond the strike price, then it is not beneficial for buyer. Similarly, if seller if the price moves beyond the strike price, then it is not good for seller. Seller is losing on that, and to the extent it goes up, that is the loss which the seller is going to incur. So if the strike in this example that we saw, the strike was 2100, right? And if the expiry price or spot price when it is expiring, so at the end of the maturity is 2300, for example, so that means the loss would be 200 multiply by 300 shares. That means 60,000 is a loss for the seller, and this loss can be unlimited. When I say unlimited, that means you can't establish in the beginning of the trade the price of the share will just be to this level. It can't go beyond 2500, it can't go beyond 3000. Though we can say in a real situation probably it would be too unrealistic to predict it can go to any level. But in a real sense, what we are trying to say here, we say the price of a share to any level. So that means if it is 2100 right now, it can go 2500 also. So the loss can be huge for the seller. So that is what we are saying when we say the loss for the seller can be unlimited and the profit can be huge for buyer, and the loss for the buyer is the only premium which he is paying. So what the buyer has got, what the buyer has got to lose on a trade, it is the premium only. If a buyer is not see the price moving beyond the strike price, so that means the buyer would be losing the premium. That's the only loss buyer has in the deal. Okay, so now look at the buyer expect the price to go down. The same thing that we have already covered. The seller expect the price to go up. So that's the two different directional view the two players have got when they actually get into the deal. Okay, so the buyer expect the price to again in few more terms it is given there. Premium is paid, price go up, unlimited profit, price remains same, lose premium, price goes down, lose premium, right? It just has been put in different words, but it is the same thing that we have already covered. Buyer expect price to go up, sorry, premium is paid, buyer pays the premium, price go up, unlimited profit and all that. Buyer doesn't expect the price to go up, premium is received, price go up, unlimited loss, price remains same, gain premium, price goes down, gain premium. Anything not clear here, guys? We need to be clear with this thing because it is quite related and it's a technical, all or every term which is written here has got some meaning to it, so we need to be very clear with this. Similarly for the put, it's the same thing that we have done for call, same for the put here also. Okay, so this is how the flow chart looks like. The call, put, long call, long put, short put. The holder of the call option right to buy, writer of the call option has obligation to sell. The holder put right to sell, obligation to buy. Any doubt? Hope it is clear, right? So this is how the option change. If you look at this on the NSE website, this is how it would look like. So this side is a puts. You can see puts here, and this side this is your calls. So and this is your strike price. This is the strike given here for a share. Which share is this? I think its share name is not given here. Bajaj Auto. It is given there, right? Bajaj Auto is the share. The expiry date is it is 27th September. So September month 2008 is the it's an old screenshot. So different strike is given. So you can buy any strike as per your understanding. So what is the current price? The current price is 2879. This is spot price for that share. Can we see this, everyone?
Yes, sir.
This is your spot price. So there you have got the strike prices. So you can take any strike as per your wish. You can take put, you can take call also, and accordingly you would have to give the premium for premium is there, which is their last traded price. So this is your premium here. Like this is the premium given here. No, this is the last traded price. So premium is basically bid price is there. This is the bid price, and this is the ask price. Right, so buy price and the sell price. So how, what is the buyer's price and what is the seller's price? That's given here. This is a bid means buyer is buying this, seller is selling at this rate, and the quantity is this is given there. Can we see bid
Yes, sir.
quantity is also there, sell quantity is also given there, net change and all this is given there. So this is how the option chain basically is also seen for the point of view how what is the expectation of different investors from a given share. So at times we look at option change to analyze what are the investor thinking about a given share, at what level it can go, though it would not be always true, but there are some investors who have some inside information also. So with that we can know where they are placing themselves, where they have made their position, if they have made a position at a particular level, or if they are unwinding their position. So that reflects they are losing confidence from that strike. So there is a possibility of volatility coming, or there is something
happening with the share. So it may go up and down according to their understanding, and therefore they would be unwinding their position from that given strike. So that may happen. So that is one reason why option chain is also analyzed. So can you look at this? This is open interest is given there. Open interest is, what is open interest? Anyone? Any idea? Anyone has an understanding of open interest? Can you see OI? OI is open interest here and here, both sides. Because now we are looking at the option chain, so we also understand. So the important things to understand is strike price, right? At what strike I am buying. So this is absolutely important for strike. Ask and bid is, you would not ask, is basically the seller price. Bid is the your price. You, if you are buying an option, call option, so you would be putting this price. Seller is ready to sell it on this price only, right? Not at your price. Quantity is the what quantity is basically a lot, you can say.
Lot.
This, right? So if it is 500 is a quantity, that means you are buying two lots. If it is a 250 quantity, that means you're buying one lot. Or Bajaj Auto has got a lot of 250 shares, right? So this is how you look at quantity. Okay, so now let's come to the open interest thing. Anyone has any idea what open interest is all about?
Yes, sir.
Sumit, yeah, go ahead, Sumit.
Sir, buying a option or sell a option is a contract, and
Right.
open interest represent the number of contract open in the market.
Yes, right. Right. Well, yeah, well said. So open interest is basically gives you an idea how many open interest, how many contracts are open on a given day in the market, right? So if you look at here, can you see how many open interest are there? There are 1,12,250 open interest. These many contracts are live. So and then you look at here, 1,94,000. So if you have a very huge open interest at particular level, uh, usually in lakhs, or rather I would say around 10 lakhs and more. So that basically signifies the investors have very great confidence at that level or that strike price. So there is one way of looking at. So I'm not saying this is a hard, this is a sort of a the thumb rule. It's not a thumb rule, because if had it been a thumb rule, probably everyone would have benefited from that, right? So there is no thumb rule in share market or in financial market. These are all understandings which are built with some sort of analysis, which is a historical analysis, you can say, because everything which is made out with the historical data only, right? There is, you cannot predict the future thing, but you can analyze and you can see the data which is available, yeah, at your disposal, basis the history has thrown, and that data you can analyze as basis that you can probably make positions in that. So if the open interest are more at a particular strike, that basically reflects in a sense that people are more confident that this level would not be achieved or it would not breach that level. This is the fundamental understanding goes behind the option chain analysis. So why people do option chain analysis? This is the reason why the option chain analysis is done. Clear, everyone? Any thought, any question, any doubt? Okay, so I will move on, assuming there is no questions here. Okay, so this is the trade economics. Trade economics is basically what all things are there in a trade. So trade date is when you are actually doing that trade, the date on which the option is agreed between two parties. Settlement date is a date when the trade is going to settle or expire. Date on which the cash security option is moved between the two parties, right? So that is called the settlement. So the slight difference, I would not say it's the same settlement date and expiry date. Can you, maybe somebody has an understanding, what's the fundamental difference between a settlement date and expiry date in case of option?
So may I?
Wait a minute, maybe somebody else apart from Vibhav and Sumit, maybe anyone else has any clue? Sorry, I have got a very as in severe cold. I hope I don't have corona. So Anyone before I ask Sumit or maybe Vibhav to explain it? Yeah, who? Who's that?
The Ishika is
Ishika. Okay, go ahead, Ishika.
the expiry date means the date on which the option or the agreement between the parties is going to be expire and none the party take any action for that agreement. And settlement means that the parties are agree and move and just ready to take decisions upon the agreement.
Okay, fair enough. Okay,
Sir Prakhar, hello.
okay. Yeah, Prakash. Yeah, go ahead, Prakash.
Yeah, sir, for me, like expiry date is the last date on which the seller or buyer has to decide whether they exercise their option or not. And what about the settlement date? The settlement date is basically a date where the securities or the securities which has been moved between all the two parties, means the settlement option is done, means square of the securities will be done on that day.
Okay, okay. Anyone else? Okay. Okay, fine. So maybe Vibhav, yeah, you can go ahead.
Yes, sir. Expiry date is basically the date where the option is expired. Even if you exercise it or not, it will get expired on that date.
Mm.
So there's one thing, either you can exercise it, for example, you can convert it into shares, or you can sell it, or if you have, short the position, then you can buy it. That's what expiry date is. The settlement date is like, as a few months ago, SEBI also used few new settlement instructions, T plus one, T plus two, which we have discussed in classes earlier. So that's what the
Uh-huh.
settlement date is, where on the expiry date you exercise the option, and on settlement date the option is passed between the two parties and you get your cash. That's what
Right,
it is. Basically,
right, right.
liquidation. Your options. You convert them liquid on the settlement date.
Okay, right. So that's true. So expiry date is the date when the contract is going to expire. So every month, every 2 month, every 3 month, the option contracts expire, right? So whichever contract you've taken accordingly, that those contracts will expire in that sequence. And once expiry is there, so either you close your trade before the expiry, or if you don't close your trade before the expiry, so you know the expiry is will take place automatically, and therefore you're bound to go for the settlement. So if I have sold a put option, for that example, I am the seller of a put option, there would be a buyer for the put option, right? So as a seller, I need to square off my position before the expiry or on expiry, right? On expiry, I'm supposed to close my position. If I don't close my position, that basically means if the option is in the money, yeah, okay, probably I'll talk about it later also, because you're not familiar with in the money, at the money concept. Everyone would not be familiar. So if the option is in the money, so that means I have to take the delivery, and therefore it would go for the settlement, and settlement cycle in India is T plus 2, we know. So the settlement can happen only 2 days after the expiry, right? So expiry, whatever the expiry date in a month is there, and so the settlement will take place after 2 days, right?
Sir,
If
can I,
yeah,
sir,
Sumit,
can
go
I
ahead.
add something? Yeah,
Yeah, sure.
sir, expiry date is the date on which you can hold the option contract till the expiry date. You can hold the option contract, and
Hmm.
settlement Settlement is something that there is two types of settlement in the market. One is the cash settlement, the second one is physical settlement. In cash settlement, it is done on the same day of the expiry, in the evening of
Right.
expiry date, and next day you get the settle amount. You get the
Right.
settle amount in ledger. And another one is physical settlement. Physical settlement is something that it settle in a T+2, where securities or the underlying commodity is settled by, either is by transferring from the one party to another party.
Right, right. Well said. So this is true. He said it rightly. So on the expiry date, you have an option for having a cash settlement the same day, and the cash would be available the next day. And for the physical settlement, the process has a T+2 days, right? So if you are not going for a physical settlement, then the security settlement will take place on T+2 basis. So that is the settlement and the expiry date, two different things we have. Premium, you understand the premium is, I'll not be talking about it. Premium date is the date when the premium is paid. American. Okay, exercise type. So there are different kind of options that we have in the options market. So it can be American, European, Bermudian. So what Bermudian is, we would be probably talking in the next slide. And the direction, type of option, it can be call input. Notional is the notional value, is the amount of the total agreement, total contract lot value. That is the notional value. Strike is the particular strike for which you buy it. So that we in the option chain also we saw these different strikes available. So these are different strikes. One can 3100, 3005, 3020 different strikes. So one can go for different kind of strike prices when the when an investor is thinking of buying a call, either call or a put option, right? So then this is how the strike is. The counterparty is the other party in the transaction. So that is called counterparty, right? Okay. There are two options that we have. One is the American option, common style, which I'm talking about. This is the most common one, vanilla option that we say. So one is the American option, another is the European option. What are two difference between this American and European option?
Sir,
Basic difference
in
between these two.
American option, option holder can exercise the his contract anytime till
Uh,
the time of the expiry. But in European
mhm.
option, you can only exercise your right on the expiry, not the before the expiry.
Okay, right. Anyone else? Any other thought around it? Okay. Okay, so that is right. So in American option, you have this an option wherein you can exercise your trade any point in time before the expiry or on expiry. However, on European option, the option given is this, where you can exercise the deal only on the expiry date. Though you can close your trade before the expiry date for sure, but if you want to exercise or want to take a physical delivery, that is possible only on the expiry date, not before that. So that is the two different common type of option that is available in the options market. One is the American option, another the European option. Which kind of option do we have in India? Is it European option or the American option?
It's European.
Okay. Okay, so yeah, right, that's right. We have an European option. We don't have an American option in India. It's European option. We can take a physical delivery at the end of the expiry only. We can't have a physical delivery before that, right? So let's move on. Okay, so this is the types of other style of options. So what is Bermudian option? Any idea? What a barrier? What a Asian? What a binary? What a exotic? Other exotic?
The
But
Bermudian
there are a lot
option
of
is the
yeah.
sir. Sir, Bermudian option is a kind of mixture of American and European, but only difference is that in Bermudian option you can either exercise your right on a specific date given on the option, or on the expiry.
Right, right.
I can
So
I
right.
can explain it. I can explain it with example like there is a contract which expiry date is 30th November, and you bought your option on 1st of November. So there is a specific date, like you can exercise your option in 15th of November and 20th of November, apart from the expiry date, which is 30. So if you want to exercise your right, you can do that on 15th and 20th November as well, apart from the main expiry date, which is 30th.
Right, right. So the Bermudian and yeah, Bermudian option, right. He's right. So it's in a hybrid option in a sense. It's a mixture of both American and European option, wherein you have got some flexible dates where you can also exercise the option and take the delivery of those agreement which is done in the beginning of the contract. So this is the Bermudian option. Okay, the good part about these are the OTC product. Bermudian option, when you look at, are most of them are the OTC one. So here you can even have a maturity of 6 months. It is not necessarily you only have an option of 3 months like in the normal vanilla option thing where you have maturity of 1 or 2 months. There could be a probability wherein you have a 6 month and longer. So there could be a date given that you can exercise after a month or two, or after 3 months also. This can also be an option given there in the contract that you can exercise maybe on the 15th of third month, maybe 15th of fourth month. So these dates can also be, so it can be customized. It can be customized as per the requirement and made it available to the investors. So that is the beauty of these option contracts that we have in the options market. So Bermudian option, I hope it's clear to everyone. It's a hybrid of American and your European option. It gives you flexible dates. Some of the dates agreed upon in the beginning of the contract, and those dates are the dates where an individual or the investor can exercise the contract before the maturity even. And on the exercise, the final maturity, it can be exercised for sure, like it is available for American and European option also. Right? Clear everyone? What are the barrier option? Anyone has any idea? What a barrier option? Anyone heard it before?
Yeah, sir, I heard it before. I read it somewhere
Yeah,
when I
yeah.
am studying some options. So Bermudian option is like normally what happens in option that whenever you are in a favorable position, you can exercise your right. Mostly
Okay.
you exercise your right when you in a favorable position, but
Hmm.
uh, in a barrier option style, where you have to cross some level so that you can exercise those your right. Otherwise, if you are below that level and you are still in a favorable position, but you are not crossed that level, you can't exercise your right. So in a barrier option, you have to not just you have to be in a favorable position, but you have to be cross the barrier or level which has given that particular option. If you cross that particular barrier, you can exercise your right. Otherwise, you can't.
Right. So that's true. So the barrier option, as the name suggests, it you individual or the investor has to cross a certain barrier. So there would be, just to give an example, you buy a TCS share. So there is a strike of 2100, right? And then there is a barrier of 2100, right? So strike, you need to have two things in that contract. One is the strike price, another is a barrier. So if it crosses the barrier, only then you can exercise the contract. Unless it is of no use for the for an individual or the investor who is taking part in barrier option. So again, it is an OTC instrument. It is an OTC instrument which are designed for the purpose of some hedging and all. And the thing about the barrier option is there's so much customization, right? So the premium paid is also low, right? So if you see, there is a strike price which is 2100, as I said, in case of share. and if you go for the barrier option, there is a barrier given for 100 200 for that matter. So who moves beyond 20 are not supposed to exercise. You would not be able to exercise. So that is the customization that barrier option has got. What is binary option? What a binary option? Any idea?
The
Okay.
binary option is the condition where it is condition like it is bet. If you won, you get all the money. Or if you lost, you lost all your money. So it is a bet or condition type. It is a bet kind of option where you either you get all money, or either you lost all the money.
Yeah. So binary has two things. So as an individual binary, when you buy a binary option, so it is true, it has binary means two things, right? It's either 0 or either 100. So if the option is giving you 100 rupees, so it can be 0 or it would be 100. So this is for sure going to happen. So that will happen when you assume a condition. Condition is you feel like you take a strike of 100 or 200, 2100 for that matter, for the T share. You've taken a strike of 2100, and then you also the binary option also have some timing things. So you need to go with the time also. Two things also. You take a strike, you also take the date, time also. There can be customization of time before 12, before 11, before time. This time you would be having a strike of 2100 and more, right? And in case of put, you would go for a strike that it can touch to the lower side. So if an option, assuming the same example of TCS share, right? So TCS in a binary, the profit can be 0 or 100 or uh, or 1000 is premium point of view. I'm saying it can be either 0 or it can be 100. So condition uh, for the TCS share, the strike will be 2200. Okay, uh, on 5th December 12 p.m. right? So, and for this condition, for this particular option, I am giving a premium of 20 rupees, right? This is how this deal is being done. Now, assuming this happens on 5th December. December is the date, time is 12 p.m. So by this time, this actually happens. So the profit 1000 minus 20. So that means 980 is my profit for the buy. What I'm saying here. So here the two things only for 1000. So if this doesn't happen, this doesn't happen, means I'm losing 0. I'm not getting any option of earning anything. So binary option. Give me a second. Let me check.
उधर उधर महाराज वो टेबल
Okay, so clear with binary options. What binary options have and what why they are good one.
Sir,
So
I want to in binary option.
yeah.
Sir, in binary
Yeah,
option, one of the most important one of the most important characteristic the option is the unlimited profit and loss, which is not there in binary, because you know what you will gain or what you will be lost if
yes,
uh, if if it is not goes with your way.
right. So
So
as you see here, so for the option, like there is a term already decided, so you will be having a profit. You can have a profit of 1,000 zeros, right? Maximum profit can be 1,000, not more than that. And now it depends upon the contract at what price you're buying this option. So maybe you're buying this option for 20 rupees for that matter. So your profit would be 980. Complete 980 would be your profit. It won't be more than that, and it can be it can be 1,000. You're getting the contract for lesser, uh, but you can't get the contract for free first, right? So it'll be something less than 1,000 for sure, but it can be quite a good amount also. It's a sort of a condition where you are just going with that particular condition, that if at this particular day, at this within this time, if you meet this target, then you can avail the profit of this. Otherwise, you lose everything. So if you don't find a strike of 2,200 on this given day, then you are going to get zero. That means you lose your entire money. So premium is on, and seller will get to uh, will get hold of that premium money, and the deal would. So that is how the binary options work, right? So these are again, these are some of the hedging instrument, you can say. So this is why these are good, because the option premium paid is not huge on these instruments, and that's the reason these are the OTC products, as I said earlier also. So we clear with binary option also. What are the Asian options?
Actually, the payoff on this option depends on the average price of the underlying asset.
Right, very nicely said. Yeah. So when you talk about the Asian option, so Asian option is basically you taking the average of maybe you taking the average of a month. So if you in 3 month Asian option, right? You know, average of every month, first month, second month, and third month, and then you will match with the strike. So assuming you have taken a strike of 2,100, same TCS share, right? Strike taken is 2,100, and option contract is for 3 months. 3 month option contract, call option. 3 month option contract. Now you take the average for the first month. So when you take average, you would be actually arithmetic average for an entire month, and that average comes out to be 20,080 for first month. First month it is, right? So how that average would be coming for first month? So that means the movement of the share would have been bit lesser to 2,100 also during few days in the month. So I'm talking the average for the first month, not first day, right? So month average is this. Sorry, right? So this is your month average, and second month average might be 2,150. 2,150. Third month average is 20. So now you take an average of 3 months. 3 months. You take an 3 months. So this plus this. Sorry. You add this. Okay. So this is the total value for 3 months, and now you divide it by 3. That's the average, right? So that's the average for this option contract. So what was the strike price? Strike was 2100. 21,433 minus 2100. So your value is 43 profit. So you are getting a 43 rupees profit on the contract, multiply by the number of shares that you have got in the contract. So that would be your profit for the for this given Asian contract. Clear, everyone? Any doubt with this one or maybe the other item that we discussed on this slide? So we should
No, sir.
have some idea about the different exotic products. So there are many more, but we have talked about the one which are quite prominent or known in the OTC market. It can be any exotic product in the option category, because these are made with the requirement of the counterparties or the parties in the OTC market, and these are some of the examples. The good part about these contracts are that these are uh, these are having less premium compared to your normal common option contract. So if you look at, because these are very customized one, and these the risk not for us, because if you look at from the OTC point of view, OTC market is primarily made from the practical use. It is not made for speculation. It is for practical use. Though speculation happen, I won't say the speculation is not there, but it liquid wherein everyone or retail customers can be part of that market. It's not possible for the retail customers, and retail customers actually make market more speculative and more attractive. So it is more for the big players. They part and they take these kind of options to build some sort of hedging around the products which they have with various counterparties. Okay, moving on to other thing now. Okay, so these are the payoff. Any ideas of how you would be making a profit on an option contract when you are buying a call option or a put option or a short call or short put? So how you would be profited from a deal? So that is what is represented in a graph form. So that is what is shown here. If you look at here, you are taking a strike of 100 rupees, which is shown here in this example, and what profit you would be making when a share price move according to these ranges, right? So is given here, strike price is given here, profit and loss is given here. So you can just look at this thing and draw this payoff. So this payoff is basically the representation of the table only, the table which gives you a detail of premium, strike, profit and loss, and the spot price here. So that is represented in the form of a graph, and that basically gives in a very uh, that's a good show if it is a win, where it is a win, where it is a profit, where it is a loss, and all those things can be seen very clearly with the help of a graph. So if you see an individual takes a strike price of 100 rupees, right, and if the share price is, we're talking about a long call here, right? This graph that we are looking at, or table that we're looking at, looking from the long call point of view, from the long call point of view, yeah. So you are having a strike of 100, and if the price of a share is 10, or the underlying that we're talking about, the underlier is at 70, so would it be a profit? Would it be loss? If it is a loss, what is the loss? Everything is given there. It is just you need to say, if the underlying price is 70, what would happen in case of long call? If it is 70, you are losing premium 5, right? That's it. Right or wrong?
Yes, sir.
Right? So if it is, if you are taking a strike of 100 for a call option, and assuming the underlying is again the TCS share, because I want to keep it consistent so that you can relate it. So the underlying is TCS share, strike I assume is 100. So you assume the strike would be 100, but this hovers around 70 only. It doesn't move at the expiry. So what would be the situation? The individual will lose premium which he has paid on the trade, right? Similarly, if the share 75, what will happen? Same thing. Similarly, if 90, same thing. 95, same thing. 100, same thing. And at the 105, what will happen?
Will happen. He'll get the premium back.
Okay, okay. So at 100, any anyone else? Not not able to understand any doubt here? Not sure what is happening.
Not
It
able
is
to
difficult,
understand.
guys. Harshit, who's this?
Siddharth,
Siddharth. Okay, no worries. So Siddharth, basically what we are saying here is we are actually drawing, or whatever we have talked about so far in case of call and your call option. So same thing we are drawing in the form of a graph, right? So let's assume you are an investor, right? You have bought a share, and rather you bought an agreement call option, call agreement, right? So there are options, call and put option. So you are buying a long call. When you say long call means you're buying. You're not the seller. You are a buyer on the call option. So right.
and
So what is the view? So when you are a long call, when you are long on a call, you want share to move up or you move down. First of all,
up.
up, right? That is the view you have as a long call. When you are long on a call, that means you want share to move up. That's true, right? So now we have just made these conditions here. Assume your strike is there. It is not changing. Is it changing? It's not changing because it's
No.
agreed. It's agreed. Premium is
Yes.
changing, not changing, because once you paid a premium on an agreement, it will remain same. So what at different levels we are looking at the same thing at a different price level. We are checking what is happening. So when I look at level 70, that means that when the share price is 70 for these for the same, I am not getting anything. What I am getting is I'm losing 5 rupees. That is the premium amount.
Yes.
But that 5 rupees loss which we are talking about is basically the premium loss which you
Yes,
paid
sir.
to the seller of the call option. Same, if you look at, if you just analyze the same thing at level 80, what is happening? It is nothing, same thing which happened at 70 also. That means you are losing. Thing is there is nothing, no changes to the situation which was at 70. So again you will lose rupees 5. That's premium.
Yes.
Yeah, Harshit, yeah, go ahead.
There is no profit, no loss if price goes up by 1.5 because the investor already paid a premium by 5. It
Yeah,
goes by up by 5, then there is no profit, no loss situation.
right, well said. So on 105, you paid a premium of 5 rupees, but you also made a profit of 5 rupees. So that means it's a no profit, no loss. And this
Yes,
no profit and no loss is called in a technical word, what is this? This is a word that is for no loss, no profit. It's called
break even.
yeah,
Break,
that is called break even point, right? So break even point means there is no break even, there is no break even here. So it says it is no profit, no loss, that we say. Similarly, if it moves to 110, you make a profit of 5 rupees. It moves to 15, you make a profit of 10 rupees. If it moves to 120, you make a profit. Same thing is shown here. That's it. It is a payoff diagram. It's a payoff. Okay. Graph. It's a payoff graph here, or it's a table that we have formed. Same thing is case of short call. There is another payoff. So I will not be looking at this again. You understand this. You need to, maybe if you don't understand, you let me know. We can talk about this. It's simple. It's not difficult. If you understand this, you understand this also. Same in case of long put. Same in case of your short put. So this is a payoff diagram, and then all of them together in one slide here. Okay. So now let's come to this. What is the role of premium in the option break even point? What is the role of premiums in the option break even point? These are just questions for your understanding. What is the break even? Break even is a no profit, no loss. Like, so if you paid a premium and if you are able to reach a break even point, that means you are managed to have no loss in the deal, right? You managed to have no loss. Why would you trade a short call? Why would you trade a short call? What is the idea behind doing the short call? After this, we'll break for 5 minutes, 5 or 10 minutes, then probably we'll start. What's the idea behind a short call? Yeah, quickly. Now I expect everyone to understand it because at length. And
that the
what is the yeah?
that the price will go down and I'll gain unlimited profit.
Okay, okay. What about others? What's the idea behind short call? Why would a trader do a short call? Yeah, go ahead quickly.
Explain it if everyone wants.
No. It's enough. It's enough. Maybe others. It is enough for understanding. And yeah, yeah. Go ahead. You maybe explain. What's the idea behind a short call? Not clear. Then we can discuss it. But just try to put it in your words. So try to draw some explanation around it, whatever your understanding is.
Short call, the seller in the short call is expecting that it will go, the price of the share will go down.
Right. So everyone is clear, right? So when there is a short call, so seller is expecting the 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 price of share the share of the price would not move beyond the strike price, right? It would remain under the strike price. So there is a strike of 2100 in case of TCS share that we have talked about. So if I am the seller, you are the buyer. So my view is the share price would not go above 2100. It will remain under 2100, and therefore I would be able to make a profit of premium. So what is my profit say? So I would not be having an unlimited profit for a short call. Whoever is doing a short call, that would just be getting a premium profit, right? Agree or not agree?
Yes, sir.
Okay. So why would you trade a long put? Why would you trade long put? Ishika, Ishika there? No, she Abhinav, Abhinav is there? Yeah. So why would you do a long put? Why would you trade a long put? Any idea why the individual understand do a long put? Abhinav,
Sir,
yeah,
hello.
yeah. Go ahead.
Sir, when stock price is down, then seller can choose.
Okay. Okay. Apu, what are your thoughts? Why would why would you trade a long put? Yeah, no idea.
Sir, can I answer?
That okay. Before that, maybe Sudiksha. Sudiksha, would you like to maybe elaborate why would you trade a long put to have an understanding around it?
अच्छा पास आओ ना, पास ऐसा क्यों हो रहा है, पास ऐसा क्यों हो रहा है? अरे वो
Prakhar, you saying something? Prakhar is saying something, right?
yeah, sir, wait, I'm just telling what the why we are taking long put. Actually,
Uh-huh.
when
Uh,
investor expect that the stock price will, then
okay,
he will execute the put option.
okay, okay, fair enough. Okay,
Able to
Siddharth,
hear
now
you
you.
actually.
Uh, sir, I have something to say.
Yeah, go ahead.
Sir, question is why investor go for the long
Long put.
sorry, long put. Sir,
Yeah,
again, there is a long put. Long put means if a price of the underlying goes down, then put premium of the upside.
hmm.
Why people do that? Because again, those three participants of the market comes to play. First one is uh, arbitrager. Arbitrager also works in these options to get with the cash price, sometimes price or sometimes with the future price of the underlying to
Uh-huh.
get the uh, difference between
Uh,
those two contracts. Second one is hedger. Lots of hedger who has the position with the underlying stock like in TCS. If you have bought TCS cash TCS stock or TCS future, then you can hedge also with the uh, by buying a put long
yeah.
option. Third one is the
Okay.
speculator. Speculator also they are like I in my view TCS will go down in coming days. So, but I
Uh-huh.
don't have money don't have the money, or don't want to pay the whole the margin money. So I just want so I just buy the put of much uh, much less, which I need to invest much lesser amount or the stock. So and get the and I can get the uh, benefit when the TCS price goes down. So all the three
Okay.
participants of the market is are active in the options.
Right. Right. So he well said. Yeah. So there are various reasons. So why a person would be doing a long put. So we probably at least need to come out at least with one option while we are talking about it. One reason why we are doing a long put. So one reason I expect from everyone to be very clear of. So when you're doing a long put, the basic reason is you expect a share to down, right? When you expect a share to go down, that is the reason you're taking a long put, right? Everyone is agreed with this point or not?
Yes, sir.
Fundamental is that you expecting down. So that is the basic idea when you as an investor go for a long put. Other than those reasons, wherein you can also go for a hedging. So how can you do a hedge here? Can this long put be utilized for hedging also? Any thought around it? Can I use long put for hedging? Okay. Let me just put it this way. So you are holding a share of TCS, that is 300 you are holding with you, and you bought those shares at a rate of 22,000 rupees, right? You bought those 300 at a price of 200 rupees each, 2,000 rupees each. So now you fear if your value goes below 2,000 rupees, the share value goes below, it is a sort of a loss to you, and you intend to sell out those shares in a month or 2 months time from now. So therefore you have an option of a long put. You can go long put to buy a strike of your choice. So you can go for a strike of 2,000 rupees by paying a certain amount of premium to the seller, and you safeguard your risk which is coming because of share going down, right? So that risk is there. So this option, this is a long put option which is giving to a buyer. So you buy a long put, and with that you curtail the losses around a security price going down. So you know now if security price goes down, also you can exercise the option that you have and can overcome the loss that you bear with the option price with the share price going down, right? So this is also the hedging instrument is there. Why would you trade a short put? Okay, so I would leave the questions now. Yeah, why would you trade a short put? Any idea? Why would you
So,
trade a long call?
so when you're expecting the market will go up, then you trade a short put or a long call.
Yes, right. Very well said. So you're doing long call and short put. The reason behind these two is more or less similar. The only reason is when you do long call, it is from the buyer point of view, standing as a buyer. Or however, when you're doing a short put, you're standing as a seller, right? In long call, the view is same. View is in short put. The only thing differs is you're taking you're taking a buyer position in long call, you're taking a seller position in short put. That's the only different thing happening. Otherwise, the views are different in both these long call and short put, right? What is the break
Yes.
even for call option only for only strike and the premium?
Sorry, sir.
What is the last one? What is the break even point for call option for only strike and premium? The question is bit not clear here, but it is if you have taken the same thing that we discuss here, right? So here need not be bothered about. So it's the same thing. The break even is 5. This is 105 in case of call option. This is
Yeah.
5,
If
right?
if the market price has moved up to a
Yeah,
level where our premium could be recovered if we uh, exit that position, then that point is known as break-even point.
right, right. So that's it. So I would be fine here. So now coming to this. Okay, let's have a break for 5 minutes. Then we'll start and cover the remaining slide. I guess we have got some 20 slides more, or maybe 15 slides more. So we'll cover it later on. Okay, let's have a quick 5 minute break. Then we'll start. Okay. Okay.
Yes, sir.
Yes, sir.
Okay, so all set, right? So everyone there?
Yes, sir.
Okay, fair enough. Okay. Okay, so now we will understand these terms, which is in the money, at the money, out of money. These are few terms that we should be very clear of, because these are relevant when we talk about the option as the instrument, right? So when you talk about in the money, so in the money is basically when you are in profit. In a very simple and layman, I would say in the money means in profit. At the money means when you are neither in profit nor in loss, so that means you are at the money. And out of money is basically you are in loss, you are not in money, you're not in profit. So that is how these terms are looked at, and that is how we should be understanding these terms. So when you look at this particular slide here, you can see there is a call option, there is a put option, right? So call option, the exercise price is exercise price, or you can say your strike price. You can say both the same, or both the things are same. So exercise price is 90 and the spot price is 100 rupees. So would you say is this in the money, or would you say it is out of money? Yeah, yeah. Harshit, what is this? Is this in the money or it is out of money? When the exercise price is 90 and the spot is 100. Any
In the
clue?
money. In
The
the
In
money.
the
exercise
money.
price, exercise price means the price which is going on right now, or
No,
the price
exercise
on which
price.
we bought it.
Yeah, no, exercise price is the same the strike price, right? Excess strike price, your strike price is 90, right? The strike
Okay.
price is 90 and your current price, that's the spot price is 100.
Okay.
So how do you look at this situation now? Do you see it profits? Do you see it in the money situation, or do you see it out of the money, or do you see it as at the money situation when you look at these the few prices along with your current price? So how do you analyze and how do you see what these situations look like,
So it's in money.
right? In the money, anyone has a different view? So basically you took a strike of 90 rupees and your option has already moved. Your already option has moved in the upward direction. So it has crossed this strike and it is trading at the moment at 100 rupees. So you are in the money, and you are in the money by how much? 10. I'm not taking the premium thing at the moment, but if you look at the difference between the spot price and the strike price, that's a 10 rupee difference. So 10 is the in the money amount, right? Similarly, if you look at here, what is this? Is it at the money, or what is this?
At the
This this thing at 100 at the money, right? So we are clear with the concept, right? In case of call, this would look like this. In case of put, this is the strike price and this is the spot price. So is this out of money?
Yes, sir.
Correct.
Yes, sir.
And when it is 100, you know, when it is 110
In the money.
in the money. So strike price is higher than your current price. So that is when you are in the money, in case of put options. So now the status of an option, when you look at this, there are two things which an option has. One is the time value money. As from the higher level, we can see that two things, but there are few more that we would be talking later, not at this moment. One is the time value and there is the intrinsic values. So when you say intrinsic value, so intrinsic value is basically the current stock price minus the strike price. That is called the intrinsic value, right? So intrinsic value, if you here, in case of in the money option, 100 minus 10 is the intrinsic value, right? You minus the value of your option which you bought from the spot price to the strike price. That is called the intrinsic value. Then there is another value that is called time value. Time value basically means if there is a longer time horizon available with you for the trade to expire or trade to mature, that means there is more value that would be assigned to the premium of the option. So option premium, how the option premium is calculated, there are two major factors, but there are more factor. It is not only two factor. One is the intrinsic value, another time value. So time value means if there is a long time available for it to expire, so that time value will be factored in, and accordingly the premium value for an option would be higher. So assume the trade or the option is just going to mature today only, right? Today is a business day, and we believe today the option is going to mature, and it is going to have the same thing here, that the strike is 90 and the spot price is 100. So that means the option just has got what? The intrinsic value, because time value money is almost going to be zero very soon. It is the same day of maturity, right? So these two things you need to remember when you talk about the intrinsic value. Intrinsic value is what value it is ahead of the strike value. That is called the intrinsic value of the particular option. And when you look at the time value basically means what time you have left for an option that would be factored in when the option premium is calculated. So that is how we look at these two things. Clear? Any doubt here? What is intrinsic value, time value?
So what is the significance of these terms in option chain?
Significance is because there is a basically it is to have a right fair value of option. So if there is a time value, so there is a more time left for an option to expire, right? So the premium of the option would be higher. Assuming, just look at an IGL. So IGL was trading, IGL in Indraprasth Gas Limited, it was trading around 5 rupees on Friday, on Thursday rather, I would say, right? But on Friday, on I'm just taking an example. So on Friday, Thursday, it was trading 5 rupees, and the next day when the expiry day comes, just taking a hypothetical example, as we know it's a Thursday is the expiry, right? So I'm taking a hypothetical example, making the Monday as the next day of the expiry. So next day when it's expiry, right, there is no further time left. So the time value factor, which was increasing the premium of the option, would no more be associated with it, right? Given it is the last day, so there would be much of the time value that would be increasing the value of the option. Volatility is another factor which also increases the value of the premium. Volatility basically means how soon or how frequently, how often the share value can shift from upside to downside, downside to upside. So that is what the volatility means, right? So if there is a very frequent sudden movement happens on the share, then that factor would be included in the option premium, and that would be inflating the value of the option premium. Option pricing, basically, I'm talking. When I say option pricing, means the option premium, right? So the
Yes.
inflation can be due to the volatility in the option premium. It can be due to the time value. It can be due to your the few option Greeks that we would also look at maybe in this class only at the end. But the two more, there are three factors which are the prime factor dominating factors are your time value, your intrinsic value, and then the volatility. So these are the few factors which
Right, right.
actually increases the option premium value, right? Then other than this, there we have rather five factors which actually make the premium. So those five things are called option Greek that we will look at when we actually start with the option trading. The first thing, option strategies, then we would actually look at those five factors. One is your delta, then there is a theta, then there is your volatility, and then there is the interest change. All these things that we would look at when we start with the option Greek. But important thing at the moment to remember is one is the intrinsic value. Intrinsic value basically means what level the option is traded from its strike price. If it is moving ahead of the strike price, that means you already having an inbuilt value, intrinsic value, that we call that there is an inbuilt value. If you can also buy an option with a strike price of a lower strike price than the current price. That is possible, right? You can also buy
Yes,
an
sir.
option which is of having a strike of 90 rupees when it is already trading at 100 rupees. So that means you're buying an option that has gotten that is in the money, so that has got an intrinsic value of 10 rupees in itself. So this is an option available to an investor as well. So at the moment, I'll just talk about this, and probably later on we'll talk about more. It is just shown you there is two sides shown here. In the money is shown in green, and out of money shown is red, and this is a break even point which is at the money, right? There's no loss, no profit. And this is just for an understanding. There's nothing more to analyze here. It's just for the green side is in the money, and when you're taking in a trade of $95, so 95 is the, this is the option trade you've taken for the crude oil call option. $95 is the strike price. So this is 95 here. This is the break even point, and above 95 is all in the money, and below 95 is all out of money, right? So option pricing, market price greater than the strike price, this is the profit. When you look at the market price is greater than the strike price, so that is the profit we would say in option. In the money have intrinsic value, we know, we have already discussed. At the money have intrinsic value, no money at the money have intrinsic value equal to zero, which we know that means no intrinsic value. So how the option premium is calculated? So these are the factors: intrinsic value and the time value. So time value, when you talk about the time decay, volatility, all of these things have been clubbed together. So that is how these two things are looked at. Intrinsic value we already discussed. Time value we discussed what time value is all about. So in further we will be talking about these in option Greeks with couple of new things also. So intrinsic value and time value, I hope is clear now. When you talk about the option premium, you should be clear with intrinsic value and the time value for sure. And the other things we'll talk later. Fine.
Yes.
Time to expiration, stock price and strike and volatility. These are the three things factors affecting the premium. So time to expiration is a time value that we have already talked about. Stock price and strike price we have already talked about. It's again given in a different form. Volatility we talked about how the stock is moving up and down. So these are the factors, and these are factored in while the premium is decided for an option. So this is basically done basis the historical data and all that. So then this volatility is decided and calculated. Okay, I'll move on quickly. Risk-free rate, dividend expected. So all these things I will be talking in option Greek again. So I'll not be spending time here. That's it done. Let's now start with option Greeks quickly. Yeah, go ahead, Siddharth.
Like when we open the option deal and we try to exercise or expire that particular deal, we see to like a strike price in the barrier. So the barrier option and that particular barrier, is it the same thing or is it a different?
Can you just repeat the question? What
Like
the question is? This.
so we have
Yeah.
gone through the barrier option right now. So like when we open the deal, any particular deal, and we try to exercise or expire, okay, as per the call or the put option. So
Hmm.
so over there, when we open that particular deal, we see like the strike price and the barrier that is there. So is that the same thing that we were talking about, or that
No, no, no,
barrier is a
no.
different?
Different. So barrier option, there are this is one of the option category available, the exotic option category, right? So these are the OTC product you can say. So the barrier option have two things in it. One is a strike price, is a barrier. So like assume like we taking the TCS example, right? So if you go for a call option, so you have you take a strike of 2100 as a strike, right? And then you have a barrier, this is another number that would be 2200. So that means your option can only be exercised when it touches the barrier. If it doesn't touches the barrier, then it would not be exercised, though the strike is 2100. But if you look at a normal option, the strike is the only thing that we have when the execution, or when execution is looked at. So it's the only the strike which is talked about, it's not the other thing. So in barrier option there is one additional feature or additional thing is inbuilt. So if it goes to the barrier, if it touches the barrier, only then it can be exercised, otherwise it would not be exercised. This is why this barrier options are there. It is primarily for the hedging and all. So OTC product is there, and less premium is there, is required for the barrier option because of this feature. Because you see, if you see this, these are the quite illiquid things, so it is the OTC products only.
Okay.
Hope it makes sense.
Yes. Yes.
Okay, now let's come to the. Okay, so now when we look at option Greeks, we basically talk about how the pricing on option is done. So when you say as a buyer and caller, the two party involved in buying an option, there is another party which is involved in selling an option, right? So there is a premium which is decided for a trade. So that premium is basically done with the help of the option Greeks. What option Greeks are? There are the five option Greeks is basically Greek letters. Right? When you say option Greek letters are given, which is called delta, gamma, theta, vega, and rho. So these is something that we need to discuss when we actually talk about the option premium. So let's see. Option Greek refer to the various dimensions that an option position entails. Greeks used by option traders and portfolio managers to hedge risk and understand how their profit and loss will behave as prices move. Most common Greeks include delta, gamma, theta, vega, which are the first partial derivatives of the option pricing model. Right. So these first four are the most important one. Rho is not important. Rho is not that hugely impacting the option pricing, but it is impacting. We can't say it doesn't impact at all. So let's start with the first one. What delta is saying? Delta represents the rate of change between the option price and a $1 change in the underlying asset price. In other words, the price sensitivity of option relative to the underlying. Delta of a call option has a range between 0 to 1. 0 to 1 means it's a percentage form. If you take, it's a 0 to 1%, right? So that's a 100% you can say. While a delta of a put option has a range between 0 to -1. So 0 to -1, again it is moving in this form. So let's look at an example here. For example, assume an investor is long on a call option with a delta of is 0.5. Therefore, if the underlying stock increases by $1, the option price would theoretically increase by 50%. So what this is actually saying, if you look at this option, if you look at this example, there is a delta which is given to a particular option, and it is assumed the delta for that option is 50.5. So delta can be in the range of 1 to 0 to 1, right? As we already said, delta for call option can have a range of 0 to 1, and for put option it can have a 0 to -1. So if the price of a put option increases, it will be negative, it will be going more negative, right? And for the call option, if the price of a share increases, it would be more positive, so it would be moving from 0, it would be up and up and up. So that is the delta. So that means the pricing would be increased. How the price is increasing for a delta, right? So that is what, how the price of option is increasing, that is represented by delta. So if there is a call option which has a delta of 50, that means with every $1 increase in the share price, with every $1 increase in share price, the price of option would also be increasing by 50 cents. Getting the point what this is actually. So we assume there is a delta, and this delta is actually calculated by the historical data and all that. So there is some study which is done, and basis that this delta is actually is calculated for a particular share. So we see there is a share which has a delta of 50 cents, right? So that means if there is an increment of $1 in the stock price, so the option premium will also increase by 50 cents, right? So what I'm saying, let me just make it in this PPT. So assume the option premium for a call option, let's make it TCS only, TCS share that we are discussing. For strike, maybe the same 2100. Let's keep it the same, and the premium is 10,000 or 10,000. Yeah, the option premium for buying a lot of one lot of TCS call option at a strike of 2100 has got a premium of, and the spot price, maybe the spot price you can take is 2000, right? So this is the premium that you're paying. Now I we assume the delta, the change in price, option price for this particular option, call option is 0.50. That is the understanding built around this call option. So how it would be impacting the option price. So assume if the spot price is 200, if it moves to 201, so the option price now would be 10,000.5, right? Just to give you a theoretical understanding, it is not practically on the ground. Is this is there could be, like, because if you look at the security, it would not be 1 rupee for a security over 2000 is very less. It can move even 10 rupees. So accordingly, proportionately, it would be moving, right? So $1 I'm taking, not rupee, $1, right? Similarly, you can make it for rupee also. 1 rupee or dollar, it's the same thing, one and same thing. So getting this point here, for example, assume investor is long a call option with a delta of 0.5. Therefore, if the underlying stock increasing by rupee 1, the option price would typically increase by 50 cents. So it would be, so what is it? Gamma and delta. There are two things which are very important when you look at the option pricing. Delta basically represents how the option price is moving with a change in the share price of the underlying price, the price of the underlier, right? So that is represented with the help of delta, how the delta would be changing, how the option price will change when there is a change in the underlying asset. or the price, there is a change in the price of the underlying asset. So if there is a change of $1, the basis the delta percentage, if it is 0.5, so that means the 0.5 cent change would be there in the price of the option also. Getting the idea?
Yes, sir.
Okay, now let's move to gamma. So gamma represent the rate of change between the options delta and the underlying asset price. So this is also called the acceleration on delta. This gamma is also called acceleration on delta. So delta is already changing with the change in with a change in the share price, delta would change. That means option
Yes.
price would change, right? Delta would, when I said delta will change, the option price would change with a change in the, if it moves one, assuming delta is 0.5. So with a $1 change in the share price, delta would change 0.5 cent, 50 cent rather, 0.5 cents I'd say, not 50. 50 is a difference. So that means uh, that means basically means there is a change of option pricing. Now there is another term that is called gamma. Gamma basically means the acceleration on delta. So there would be, after a certain level, it would be accelerating delta. Delta would not be changing the same rate with which it was changing at one point in time earlier. So it would also be accelerating delta. So there would be some additional change which would be happening, in the option price with the continuous change happening uh, with the share price. So that is reflected by gamma. So if you look at this definition, you will realize what I'm saying. You would be able to relate what I'm saying. Gamma represents the rate of change between options delta and the underlying asset price. This is called second order price sensitivity. So gamma is basically adding to the delta. It's an acceleration to delta, in other words you can say. So gamma indicates the amount delta would change given a $1 move in the underlying security. So example is same. For example, assume an investor is a long and a call option on a hypothetical XYZ security. Call option has a delta of this, that is the same thing that we had here also, right? 50 0.5 cents, 0.50 cents, and a gamma of 0.10. So gamma is again is decided. So assume there is a gamma of 10. So the overall price change would be 0.6, right? So the next dollar change will represent change of 0.6, not 0.5. So if you look at this here, this time when it moved to 2000 to 2001, this happened, right? Next time when it moves to 2000 to 2002, it should be 10,000, 1.10.1, because why it is this like this, it should be 0.60 here, change additional. So it would be this plus this. Getting the point what I'm saying? So this is the change happen when it moved from 2000 to 2001. Next time when it is moving, there is an acceleration coming in delta. That acceleration is 0.10 given here. That is called gamma. Okay. So next time when it is moving, $1 move is there, one number, 1 point move is there. So it is not moving 0.5, which happened in the first case. It is moving higher, and that higher is this. So 60 is 60 change, 0.60 cent is the next change happening from the security moving 1.2 another 1 point. Getting this idea? Maybe a bit tricky here, but this is how the option premium is derived, right? So the first instance when it actually moved from 2000 to 2001, only 50 point rather 50 cents 50 cents change happen in the option premium. When the second time the share price moved from 2001 to 2002, it did not move only 0.5, it also 0.10 cents more than what it moved in the previous instance. So that will continue. So next time when it moved to 2003, so it would be again uh, your 10 cents more to the previous one. So it would be 0.70 this time. So that would be added. This is an added effect that would be reflected in the option price. Hope some sense is there. It's a bit tricky, but if you read it a couple of times, it would be easy to understand. But in the beginning, it would be bit of an effort, because these are technical terms, and these percentages and all are decided by the option, as in the writer, not the writers, I would say, but uh, there is a team which does all this research, and they give a number to everything. What is the gamma for this share? What is the delta for this share? When it reaches this, should be the ideal gamma and what should be the ideal delta. So all these things are actually decide, but at the end of the day, when it actually being traded in the market, it again goes with the supply and demand thing. So these things might not be practically same on the ground. At times these things which we have it in the theory, or when we do a theoretical thing on ground, can vary. Why? Because on ground the things are being run by demand and supply, no matter what the delta and gamma is there, but that can also be overridden by the investors, and accordingly the premium may reflect a different value than actually the option Greeks talk about. Getting my point what I'm saying?
Yes, sir.
Okay, next is theta. What theta represent? Theta represents the rate of change between the option price and the time, or the time sensitivity, sometimes known as options time decay. So as we know, as we already talked about earlier, when you buy an option and you know there is a 30 days left or some 25 days left for an option contract to expire, so that means there's a time value associated. So that is what we are talking here. That is called theta. Theta is basically the time value which an option contract has. So with every option would be having theta associated with it, and that theta would be declining with every passing day. Theta will continue decrease, and at one point in time it would be zero. So for example, you look at this. For example, assume an investor is long an option with a theta of -50 is the theta for that particular option. So option price would decrease by 0.5 cents with every day that passes, and all else being equal. So what is assumption here? The assumption is everything else is constant. There is no volatility, nothing. So there is a theta of -50 or 50 cents, you can say. So with 50 cents, the time with 50 cent, the option premium would be decreased with every passing day. So option premium is also decreasing. At one side, we are saying the option premium increasing with the help of delta and gamma that we saw in the previous slide. But at the same time, the option premium also decreases with the passing time. So in this assumption, in this particular example, what we are looking at, we are saying, let's assume theta for an option is 50 cents. So what will happen? With every passing day, the option price will also be decreased by 50 cents. So if three trading day passes, the option would decrease theoretically by 1.50, and the assumption made is there is no volatility, there is no uncertain volatility. It is all same what happened in the previous day. And so this is how the option price would look like. So if option uh, there is an option price that is of so option price basically is calculated on a lot, on a particular lot, not here taken a complete value. It's not the value which is taken, it is taken like a lot. So lot means maybe 10 multiplied by 3, or as I would mean 30 multiplied by, right? So it should be 30. No. Okay, so this is 9,000. So 30 rupees is for one share for a strike of 2100. This is the 30 rupees per share, you can say, right? So total value for the option would be, total value for the contract would be 9,000. So this is how the option premium is decided. 30 rupees the option premium, option 30 rupees. Okay, so now when you say, look at this particular definition here. So if 3 days have passed to the maturity, so that means option premium, how much would be the option premium next day? Next day it would be 29.50, right? Next, thereafter it would be 29, and thereafter it would be 28.5. And this is the assumption that everything else remains constant. There is no volatility. There is nothing. There is other things remain constant. So your premium value will also be decreasing with every passing day, and that is how it will become zero at the end of the day, or it will come at the same rate, or same rate at which the share is trading, max to max. So the premium value will become zero when it is out of money. If a share is out of money, then your premium will become zero. If it is in the money, then premium would not be zero. It would be trading at the same level. So there would be possibility of some premium at that moment also, when it has got some time value. So hope it is making some sense. But implied volatility. What is implied volatility? We discussed in theory that implied volatility means change in the upside and downside movement in a share that is represented with the help of implied volatility. So Vega represents the rate between options value and the underlying assets implied volatility. There is the option sensitivity to volatility. So Vega indicates the amount an option's price changes with a given 1% change in implied volatility. For example, an option with a Vega of 0.10 indicates the option's value is expected to change by 10 cents if the implied volatility changes by 1%. So what does it say? There would be a change in the option price, and that would be 10 cents if there is a 1% change in the, if there is a change 1% change in the implied volatility, right? So this is Vega indicates the amount an option price changes with a 1% change in the implied volatility. For example, an option with a Vega of 10 cents indicates the option's value is expected to change 10 cents if the implied volatility changes. So this value is decided. We are taking assumption in this example. The Vega is 0.10. It can be 0.2 also, right? It can be 0.3 also. So that means if it is 0.3, with every 1% change, the value would be changing how much? 0.3, right? If it is 0.2, that means with every 1% change, how much the option price will change? 0.2. That's it. Hope it is making some sense, right? So the increased volatility implies that the underlying instrument is more likely to experience extreme values. A rise in volatility will correspondingly increase the value of the option, right? So what it is saying? Increased volatility implies the underlying instrument is more likely to experience extreme values. So this value, which is 0.10 in this case, would be more if there is a security which has high volatility, especially which has a high volatility in case of call option, and this value would be less in case of put option, minus, it would be more negative. Conversely, a decrease in volatility will negatively affect the value of option. Vega is at its maximum for at the money options and have no longer have longer times until the expiration. If there is more time, the volatility can be more and the value can. So this is the implied volatility. What is rho? Then the last is the rho. Rho basically represents the rate of change in the interest rate in the market. So represent the rate change between options value and the percentage change in the interest rate. This measures the sensitivity to the interest rate. For example, assume a call option has a rho of 0.05 and a price of 1.25. If the interest rate rise by 1%, the value of call option would increase by the same row, that is 0.05. So it will become 1.30, all else being equal. The opposite is true for the put option. So in case of put option, it would be negative point. If it has got a row of 0.05 negative. If it got a row of 0.05, so it would be negative. That means 1.20 would be the option price. Right? It will decrease by that amount. Right? So this is the option Greeks. Then we have got some of the trading strategies that we need to cover. So bull call, long settle, all those things we will be covering with a few examples so that you can probably relate them, few of them. But before that, we just need to confirm. I need to confirm. Are we clear with this? Because it is a bit of a more information today, for sure. I know, but we need to be clear. If any doubt, then the other things would not be looking good for you. You would not be able to understand the other things if we not clear with this. Yeah, go ahead with your questions.
So this particular option, like delta, gamma, theta, are there in every option trade that will happen, or is it like upon
Yeah,
choosing?
no. It is these Greeks that we talk about. This is basically this is the backend thing, something which is happening in the background, which we should be aware of as an investor. One should be aware of what are the factors which are actually leading or making the option premium. So these factors are actually driving the option premium. The option premium that we are paying to the writer of the option or to the seller of the option. So basis the delta, gamma, right, and your all these option Greeks, your option premium is being determined, and that option premium is the profit for the seller of the option or the writer of the option, you can say. So how that being calculated, that is actually represented by the option Greeks, and it is for every option.
Okay.
It is for every option. Okay, any more questions? So are we clear what short put is, what long put is? All these things we should be clear with.
Yes,
Any
sir.
doubt around this, then probably you would not be able to understand the stuff.
Sir,
So let us start
everything
with
is
one.
clear. Sir, everything
Everything
is
is
clear.
clear, right? Okay. Okay, let us do one example. Let's discuss the one example, and I want you to probably understand it and elaborate on the same, what this example is all about, right? One second. Okay, there is one strategy that is called covered call. Covered call. So how this strategy is made, that is what we are looking at now. Okay. So covered call is a strategy in option trading whereby the call options are written against the holding of the underlying security. So why we are doing? The logic is we are covering the position. What we are doing here, we are actually covering our position. Which position? Which we already hold. So that is the reason we have named it covered call. Okay. So let's construct it. Make a construction. We are doing construction of covered call now. So long shares you have bought. You have long shares. That means you have bought 100 shares and you sold one call. What you've done here, covered call construction you're doing. So you have bought 100 shares and sold one call. So what is the holding with you? The holding is shares, right? Clear, everyone on the same on the same page?
Yes, sir.
Yeah, sir, I understand. I also worked on this strategy.
Okay, okay, great. And what about others? Everyone should be clear, right? What we are doing. It is not about just two people in the classroom, so I am just writing response from only two people. Everyone should be responding. If you're not clear, two or three people should not be responding. It should be everyone in the class. Then what is the point of discussing? These are things which are very, very, very good if you actually execute on ground. And I am giving you from the understanding point of view, but if you start doing them, then you can also realize these are the good thing. But you need to be smart. You can't get it in one overnight, but at least if you start understanding now, probably over time you can realize like these are certain things which you can probably learn and make use of them for your daily as your trading and all, right? But here these things are not for trading for sure, but these are basic fundamental things that we're talking here. Okay, so let's look it again. Apurv, Harshit, Ishika.
हाँ जो भाई है सर तो बोल दो.
Are you guys there, or it's not clear at all? Doubts, questions? You can ask your question, guys. That's not a problem. If you have doubt, we can we can take a pause. We can step back. We can discuss that again. It's not a problem. But if you don't respond, then probably I'll not be able to figure this out. What is going on in your mind? If you have doubt, then you in especially in online class it's more challenging, right? In classroom class at least I can see faces and can at least make out something like if it is getting in your mind or not getting in your mind. But in your online classes is a bit harder. Because unless you respond, unless you acknowledge, it wouldn't be easier for a person to understand if it is really making any sense to you guys. Yeah, Harshit, fine. Ishika, Diksha.
I guess nobody is there.
Sir, actually, your voice is bit buffering. My internet connection is not good today. Actually, some
Okay,
light issue.
okay, okay, no worries. What about others?
The covered call I'm unable to understand this one. Like
Okay,
like why we
yeah,
do this?
okay. We are yet to start it, but before probably we jump to the covered call, we need to be sure like we have done some of the things, so we are clear with those things, right? This is what I'm asking at the moment. The stuff that we have done so far, and then the option slides that we have done, so we are okay with that, right?
I have a doubt, sir. Like this gamma, beta, this gamma, theta, and delta that we have covered. These
Okay,
techniques are used to cover the premium pricing. Is
yeah,
that the reason? Or okay.
yeah,
To
absolutely, you're right.
determine
So this
price, right?
Yeah, so these are the these are the mechanics which are done to reach the right pricing for an option, right? So delta is basically representing what change would be in the option price when there is a $1 move in the security price. So as we know, the option is a contract, and that is basis the underlying instrument. So the underlying instrument is actually driving the price of an option, right? So if there is a $1 or 1 point move from a share price, what impact it would be causing on the option price is what delta represent. And then when you look at the gamma we actually look is showing an impact on the delta itself. Gamma represent an impact on delta. So if there is a $1 move, right? So what
Mm-hmm.
impact the delta would have, that is represented with the help of gamma. So let's assume there is a movement of zero point 0.5 or there's one when there is a security moving 1 point from the previous point, assuming 2000 was the TCS share, it was moving 2001. So that means the delta was moving 0.50, that means 50 cents. 50 cents was being added in the option price, right? So if
Yes.
there is another 1 point move in the option, so there would be some acceleration to delta also. So that acceleration is reflected by the gamma. So there, that is shown in that particular example that we were looking at here. One second, just let me just move back. So in this particular example we were looking at, so that acceleration is basically 0.10 cents or 10 cents, I would say, not 0.10 cents. So 10 cents is the acceleration caused by gamma. So that is 50 cents was due to delta and 10 cents by gamma. So in total, the next time the option price would be moving 0.60 cents, it would be moved, right? So option price would be increased in case of call option. So it is just to give you a, this is this is just to give you a theoretical understanding, but on the ground there is a lot of things which are happening differently, because it is also driven by the demand and supply. So volatility is also a factor. Gamma and delta are the two factors which are there, right? And we also discuss the time factor. So time factor is also killing the option price value. So time, because we know option certain has got a time inbuilt in it. It can be for a month, it can be for a 2 month, it can be for a 3 month. Longer the time horizon, the lesser would be the decrease in the option premium. If uh, if it is nearing the maturity, the more would be the time decrease, more would be the option price decrease. So this is how this relation is there with the price and time decay. So that's the reason we say is a time decay also. But here we have mentioned time decay. So time decay basically means as you approach maturity, as you near the maturity, there will be a decrease in options, and that would be killing the value of the option. So this is representing. So every option would have got some data, and with the time, the data would also increase. It would not be 50 cents. The more it reaches the maturity, this value would be increasing. So it would be adding up to the option value. So, and that is how it would be decreased. No worries. So probably as, yeah, yeah. Go ahead.
But the 50 cents and the 10 cents that remains constant, right? That doesn't change.
50 cents you say?
Yeah, yes, sir. The
Yeah,
0.50 and
yeah.
the
In this case, it will remain same. Yeah, in this will be same. It will be same. But for other example, for maybe if you take another security, right? So it will depend upon the security to security only. So this analysis
oh,
50 cent that you're looking at here is basically done for the TCS security. I'm just taking an example. Just taking an example
sure,
here. It is for maybe for, if you look at the IG, this would be different because done with the historical data and all that, then the theta and delta and gamma, all these things are analyzed, right? And that is made that if it this is the point 10 move or point 20 move and all that. Okay, guys, so now we would be ending it because I guess there is another class that we have at the moment. So but we are almost done, right? So with example, probably we'll take this example later on, not at this time. So but we can just go through the slide and let me know if you have any question, because we need to be clear with the questions and all, so that you don't have any doubt later on. Okay, guys. Any more questions before we close?
No, sir.
Okay, so fine for today. So we'll have a classroom session next weekend, and it will be communicated accordingly. And for the time for that, until then, goodbye. Take care and be safe and all that. Bye.
Sir, can you share with us your these PPTs
Yeah,
on
I'll
WhatsApp?
share. I'll share with you. Yeah, I'll do that.
Okay, sir. Thank you, sir.
Okay, bye. Take care.
Bye. Goodbye.
Bye bye. Goodbye.
Bye, sir.
क्या चल रहा है ये? क्या हुआ?